Understanding Ethiopia's new bank loan interest rates, what's changing and why it matters.
Ethiopia's economy is buzzing with change, and one of the biggest updates in 2025 is the shift in bank loan interest rates. If you've ever borrowed money or heard grown-ups talk about loans, you might wonder, what's this all about? How does it affect everyday life in Ethiopia? In this blog, we'll break it down, why these rates are changing, what they mean for the future, and who feels the impact most. We'll even explain it simply for kids. Let's explore.
What are the new loan interest rates? In early 2025, Ethiopia's biggest bank, the Commercial Bank of Ethiopia, CBE, raised borrowing costs. Posts on X from March 4, 2025, highlight specific rates. Loans for agriculture now sit at 16.5%, export businesses face 17%, and housing loans, under a 10/90ths plan, are at 15.5%. These numbers are the interest rates, the extra money you pay back when you borrow from a bank. For example, if you borrow 100 bear at 16.5%, you'd repay 116.50 bear over time. That's a big jump from previous rates, and it's got people talking. But why do these rates matter? Interest rates are like the price tag on borrowed money. When they go up, borrowing gets more expensive, and that affects everyone, from farmers to families buying homes. Why are these changes happening? Ethiopia's central bank, the National Bank of Ethiopia, NBE, is behind these shifts. The goal? To tackle big economic challenges like inflation, when prices rise too fast, and stabilize the country's money system. In 2024, the NBE switched to an interest rate-based monetary policy, setting a base rate at 15%. This was part of a deal with the International Monetary Fund, IMF, which gave Ethiopia a $3.4 billion loan to boost private businesses and fix economic imbalances. Before this, Ethiopia capped how much banks could lend, a 14% credit growth limit in 2023, to slow inflation, which dropped from 33.5% in 2023 to 20% by late 2024. Now, with higher interest rates, the NBE wants to control money flow differently, making borrowing costlier so people spend less, which can cool down prices. It's like turning down the heat on a stovetop to keep the soup from boiling over. Historical context. What was happening before? Ethiopia's had a rocky road with money. For decades, inflation has been a stubborn problem, averaging 16% yearly over the past 10 years. In the early 2000s, the government borrowed heavily to build roads and dams, pumping lots of money into circulation. This sparked growth but also jacked up prices. By 2020, conflicts, droughts, and global price hikes, like fuel and fertilizer, made things worse, pushing inflation above 30%. Back then, loan rates were lower, sometimes around 8–9%, but the system was rigid. The NBE fixed deposit rates at 7% and forced banks to buy government bonds, leaving less cash for regular people or businesses. This old way kept borrowing cheap for some, but starved others of funds, especially small businesses. The 2025 changes aim to fix that by letting rates rise naturally, encouraging smarter lending. A simple explanation for kids. Imagine you have a piggy bank, and you lend your friend 10 candies, asking for one extra candy back as a thank you. That extra candy is like interest. In Ethiopia, the bank is now asking for more thank you candies when people borrow money, say, 2 candies instead of 1. Why? Because prices for toys, food, and stuff are going up, and the bank wants to keep things fair and make sure there's enough candy for everyone. It's tricky, but it helps the country's piggy bank stay healthy. What does this mean for Ethiopia's future? Higher loan rates could shape Ethiopia's future in big ways. On the bright side, they might tame inflation, making food and goods cheaper over time. The IMF deal also opens doors for foreign companies, which could bring jobs and growth. But there's a catch: expensive loans might slow things down first. Businesses might borrow less, grow slower, or even cut jobs. Families dreaming of homes or schooling might delay plans. It's a balancing act, short-term pain for long-term gain. Who's affected most? Let's break it down. Farmers, at 16.5%, agriculture loans are pricier. A farmer borrowing 10,000 bear to buy seeds now pays 1,650 bear in interest yearly, up from maybe 900 bear before. If crops fail, like in past droughts, they're in deeper trouble. Exporters, with 17% rates, coffee or textile traders might struggle to expand, hurting Ethiopia's trade. Coffee's a big deal here. Families, housing loans at 15.5% mean bigger monthly payments. Education costs, like school fees and food, already stretched by inflation, get harder to manage when savings shrink. Communities, small businesses employ lots of people. If they can't borrow, jobs dry up, hitting towns hard. Education and food feel the squeeze most. Families might skip school supplies or meals to cover loan payments, especially in rural areas where 80% of Ethiopians live. How do these rates compare to before? Previously, loan rates hovered around 8 to 14%, depending on the bank and sector. The CB's 8.63% rate in 2021 jumped to 9.8% after reforms, and private banks charged up to 21%. Now, 15.5 to 17% is the new norm for key sectors. That's a 50 to 100% hike in some cases. Deposits still earn just 7%, so savers lose out while borrowers pay more, a tough shift from the past. Ethiopia's situation and long-term high rates. Ethiopia's 123 million people face high debt, $28 billion externally, conflict fallout, and a devalued bear, from 57 to 112 per USD in 2024. Long-term high rates could mean families, less cash for basics. A family paying 1,000 bear monthly on a loan now might owe 1,500 bear, cutting food or school funds. Decades of rates. In the 1990s, rates were 10-12%. The 2000s saw 8 to 10% with growth. 2010s hit 14% amid inflation. Today's 15 to 17% is among the highest, reflecting crisis management. Consequences for individuals, families, and communities. Here's a list of impacts. Individuals, higher debt stress, fewer jobs if businesses shrink, delayed dreams, like buying a motorbike. Families, tighter budgets, less for food, school, or healthcare. Kids might drop out if fees rise. Communities, less business growth means fewer markets or services. Rural areas, dependent on farming, suffer most. Education expenses, families cut back on books or uniforms, widening gaps for poor kids. Food situation, with 20% inflation in loan costs, meals get smaller or simpler, think less meat, more porridge.